All right, the next chapter we're dealing with here is Chapter 9, Materiality and Risk. And so, if you recall, materiality is a major part of what we're looking for as auditors. We're looking for material misstatements. And so, we're going to talk about the concept of, well, how we apply materiality to an audit. All right, so materiality obviously is a major consideration in determining the appropriate audit report. If you recall, it's there in our responsibilities section, the fact that we're looking for material errors or misstatements in the audit or in the financial reports. And so the question is, what does it mean to be material? The auditor's responsibility is to determine whether financial statements are materially misstated. They need to bring material misstatements to the client's attention so that the client can make a correction. And of course, if they don't make a correction, we have no choice but to, well, certainly we're not going to issue an unqualified opinion. That qualified opinion is going to be something that is either qualified or adverse, depending on the situation and the materiality of the misstatement. And so they have in this figure 9-1 kind of a step approach in applying materiality. And so in step 1, what we do is we set the materiality for financial statements as a whole. And so this is the maximum amount that the auditor believes the statements could be misstated and still not affect the decisions of a reasonable user. Understand that materiality for a particular audit client is not necessarily materiality for another audit client. So it's relative to a particular materiality level is relative to a particular audit client. You got a small audit client, you know, your materiality dollar-wise is going to be smaller than if you've got some large company. You know, it's going to take a higher dollar figure to be material. Understand that the lower the dollar amount of materiality that you have, the more evidence that you're going to have to collect as well. Understand that when you're setting this materiality for financial statements as a whole, it's a preliminary process, and understand that this number may change as you get into the other parts of the audit. They talk about benchmarks. Being needed for evaluating materiality, and so a lot of auditors or auditing firms set their own benchmarks that, you know, certain segments, certain types of balance sheet accounts cannot be below a certain percentage, and that sort of thing. Understand that qualitative factors can also affect materiality. Just because it's a small number, if it's something that's related to a fraud, for instance, it could affect the judgment of the auditor. Some other factors that might be material, even though they're a relatively small number, is if even a small transaction is causing loan covenants to be broken, a changing trend. They mention a company that's got a steady sales increases or net income increases or profit, or I can't remember exactly what it was, but it's been a pretty steady growth, and all of a sudden they have a 1% decrease in net income. So that, even though it's a small number, is possibly material. Management compensation, again, that's kind of an insider related party deal, so it may, even though the number may not be material overall, it might be something that may be questioning worth questioning, and possibly needs to be investigated further. And last but not least, who are the financial statement users? If the financial statement users are those that, for instance, going to be used in an IPO, initial public offering, the materiality threshold may be lower in that situation because of the potential for lawsuits by the various users of the financial statements. Now understand that there are no specific guidelines for determining materiality. It's a professional judgment based upon years of experience in the industry, as well as possibly in the particular segment of business being audited, and possibly even years of experience with the audit client. So, however, a lot of auditing companies set materiality guidelines nevertheless. All right, so if you go back and look at figure 9-1, step 2, and again, step 1 and step 2 is what kind of a preliminary planning for determining the extent of the tests that will be needed to be conducted for this audit client. And so step 2 in this figure 9-1 is determining performance materiality. And so performance materiality is defined as the amounts set by the auditor at less than materiality for the financial statements as a whole to reduce to an appropriately low level, the probability that the aggregate of uncorrected and undetected misstatements exceeds materiality for financial statements as a whole. And so, what does that mean? Well, it means that you collect evidence by segments rather than financial statements as a whole. And so, most practitioners allocate materiality to various balance sheets accounts rather than net income accounts. They're all interrelated anyway. You know, if you have a misstatement in your accounts receivable because the client missed a particular sale, well, that's affecting revenue in your income statement. So it's all interrelated. And so they refer to the process of determining performance materiality as the allocation of the preliminary judgment about materiality to segments in the financial statements. And so, let's say you believe that materiality in accounts receivable is $100,000, and that overall materiality to that assets is $1 million. Essentially, what you're saying is that anything less than that won't be material in that particular account. Anything over is material and will need to be further investigated. So they talk about the fact that auditors face three major difficulties in allocating materiality to balance sheet accounts. Number one, the auditors expect certain accounts to have more misstatements than others. Accounts receivable would be a good one. Both overstatements and understatements must be considered. Relative audit costs cannot affect the allocation. So the next thing we want to do is talk about using materiality to evaluate audit findings. And so what you have are what's called known and likely misstatements, and then likely misstatements are broken down into two further areas. The known misstatements are those that are actually known by the auditor. They have reviewed the evidence and have found certain misstatements. Likely misstatements are broken down into two categories. First is judgmental differences. That would be such things as your allowance for doubtful accounts account. Let's say the auditor disagrees with the company as to the amount of bad debt reserve that they have set aside for bad debt expense. In that case, the difference between what the auditor believes the client should be showing on the balance sheet versus what the company's actually showing is a likely misstatement. Also, projections of misstatements from audit samples. Understand that what you're doing here when you're collecting evidence is you're only collecting a sample. You're not looking at the total of accounts receivable, for instance. You're looking at a small sample, a small percentage of accounts receivable and the transactions involved. And so we have this example here where they kind of put everything together. What you have is your accounts, and then you have what the tolerable misstatement for each account is. Anything below that amount when calculating or adding up the estimated misstatement account is immaterial. Anything greater than the tolerable misstatement when adding up all your estimated misstatement amounts is material and needs to be further investigated. And so if you look at page 255, this $31,500 is calculated. What they found is in a sample of $50,000 of, I believe this is inventory, they found a misstatement, an overstatement of $3,500 in inventory. The total sampled was 50,000. The total population of inventory is 450,000, and so what they did, they extrapolated a likely misstatement in the whole population based upon the amount of misstatements in the sample population. And so you take as your numerator your net misstatements in the sample, 3,500, you divide it into the total sample, in this case 50,000, and then you multiply that times 450,000, the total population. And so what you come up with is a direct projection estimate of misstatement of 31,500. they talk about an estimate for sampling error. This results because the auditor has sampled only a portion of the audit or the population, and there's a risk that the sample does not accurately represent the population. And so in this case, what we have here is in inventory, we have an estimated misstatement of 47,250, and it's greater than the amount of the tolerable misstatement of 36,000. And so because of this, this number is not acceptable to the auditor, and something has to be done by the client to fix the problem. The other part of this chapter is called Materiality and Risk. Auditors, there's several types of risk. Auditors must accept some level of risk in performing the audit because they're not auditing everything. This is not a complete audit of everything in the company. Not all their transactions are audited. And so risks are going to exist because they're only auditing a sampling of each segment. And so there has to be a proper risk response based upon various factors that the auditor sees as a risk. What's the relationship between risk and evidence? Well, the higher the risk, the more evidence that the auditor is going to have to accumulate. And so auditors must first, as we've seen, understand the client's business and assess the client's business risk. What's business risk? It's the likelihood that the client won't meet their objectives and possibly even fail. And so you have this audit risk model that helps identify the potential and likelihood of misstatements. And so the formula is the following. Planned detection risk equals acceptable audit risk divided by inherent risk times control risk. And so what we find is that when we're looking at the company's business and learning about their business and industry, we're, of course, doing that to assess the client business risk and also looking at the risk of material misstatements. And so what comes out of that is inherent risk, which is the risk of that business in that particular industry. Some types of business have a fairly high inherent risk. in the tech business. They have a high inherent risk because of the nature of the business. Certain types of businesses have fairly low inherent risks. Heavily regulated utilities have a fairly low inherent risk because they are heavily regulated and must get approval for certain things before they can do them. Control risk, that's the risk that despite internal controls being in place, the risk that the internal controls won't detect a material error or fraud. And so tying that into the different evidence that we might collect among cycles. What auditors do, they set these risks based upon what they perceive as more risky, less risky, or somewhere in the middle. And so they describe the amount of risk that they're willing to take in each segment as medium, high, or low. And so, for instance, under the sales and collection cycle, there they feel that the inherent risk of the sales and collection cycle is medium. Meaning it's somewhere between the middle of high and low. If you look at acquisition and payment cycle, it's high. Back to the sales and collection cycle. Control risk is medium, acceptable audit risk is low, and planned detection risk is medium. And then on the next page, we have some more here. You have inventory and warehousing cycle. Inherent risk there is high. Control risk is high. Acceptable audit risk is low. And planned detection risk is low. Going back to that, essentially what's happening here is that A, B, and C affect what happens with D. Now, they talk about the impact of engagement risk on acceptable audit risk. This is normally not something that a lot of firms do, and so for that reason, we're not going to cover it. So we're going to move on to factors that affect inherent risk. Again, this is just risk that's inherent within a particular business that would cause them not to meet their objectives. Nature of the business, industry practices, non-routine transactions, makeup of the population, audit experience, prior audit results, initial versus repeat engagement. Initial engagements are a little more risky. Audit judgment required to correctly record balances and transactions. The more judgment that it takes, the higher likelihood of errors or frauds. Culture. Whether or not there's transactions between related parties. If there's any past fraudulent financial reporting. Any misappropriation of assets in the past. So all those would be considerations in effect that would affect inherent risk. Next, we want to talk about the relationship of the risks to the audit evidence. And so here, what you have to note is that as control risks increase, the auditor will want to gather additional evidence to minimize the risk of failing to find a material misstatement. Note that auditors can change the audit to respond to risks. One thing that the lead auditor may do is put more experienced staff on the audit if they feel the risks are high. After the audit's done, they probably would want to have the engagement reviewed more carefully than usual, probably by somebody who's fairly high up. Again, both control risk and inherent risks are typically set for each cycle, such as sales and receivables cycle. They also set them for each account, accounts receivable. And often each audit objective, but they don't set control risk and inherent risk for the overall audit. And so this is the relationship of risk to evidence. And so if you look at situation 1, you have an acceptable audit risk that's high. Inherent risk is low. That's good. Control risk is low. That's good, meaning they have good internal controls. Because they have good internal controls, planned detection risk is high. So the amount of evidence required is low. Going to situation 2, they've determined that the acceptable audit risk should be low. Inherent risk is low. Control risk is low. So that's good on both of those. And so because the acceptable audit risk is low, though, they're going to, and because planned detection risk is medium, those two things are probably going to make them get a certain amount of evidence that's somewhere in the middle between high and low. Situation 3, acceptable audit risk is low. We have both inherent and control risks that are high, so that's not good. Planned detection risk is low. That's not good. So they're going to collect quite a bit more evidence for that particular situation. So there's a high amount of evidence. And then, as you can see, as should be obvious, situation 4, you've got mediums all the way across, so they're going to collect a medium amount of evidence. Now, compare situation 4 with situation 2. What's the difference there? Well, it's the fact that you had probably a low acceptable audit risk at 2. Even though your inherent risk is low and your control risk is low, you've got a low acceptable audit risk for some reason, plus you've got a planned detection risk that's only medium, not low. So that's why they have the amount of evidence required being a medium. And then last but not least is 5. Acceptable audit risk is high. So that's good. Inherent risk is low. That's good. Control risk is medium, meaning their internal controls for this particular situation are probably not, or not optimal. Because of that, planned detection risk is medium. So in this case, they've decided to go with a medium amount of evidence being required. So that's just kind of an idea of the kind of situations you might run into in particular segments. Now, this whole thing does have limitations. One major limitation is that the audit risk model is difficult in measuring the components of the model. And due to the judgmental nature of evaluating and assessing risk at the beginning of the engagement, the actual level of risk achieved at the end of the audit is never really known. Tests of details of balances, evidence, planning worksheet. Here, auditors have various worksheets that they have developed to help them in relating considerations affecting audit evidence to the appropriate evidence to accumulate. And again, each firm kind of has their own setup. So when you're in one of these audit firms, they will tell you how they like to do it. And so next, we want to talk about materiality and risk and how they're related and integrated into the audit process. And so here they have a diagram of well, what it's meant to show is the relationship of performance, materiality, and risks to planned evidence. And so when you take a look at this, what you notice is that as the auditor perceives a greater risk that controls will not detect a material misstatement, the auditor's risk tolerance for detecting material misstatements will decrease to minimize the risk of error. Now note that some of these have a direct relationship and some have an inverse relationship. So for example, acceptable audit risk, if it's low, then planned detection risk will also be low. The opposite is true of control risk for planned detection risk. So anyway, take a look at that. It's kind of hard to follow, I understand. This is not an exact science, so understand that auditors will need to oftentimes revise the original assessment of the appropriate risk as they get into the audit. And so the auditor should consider the effect of the revision on evidence requirement without the use of the audit risk model.